Okay, so here's the reason why you're not rich. Let's break it down. So, and again, I'm not picking on anybody here. This is the what I'm about to share with you is valuable lessons that I'm even learning myself. For starters, one of the things that you need to understand first and foremost is that there are two different economies. There is the economy of the stock market, and then there is the economy. Those are completely two separate things. They have certain things that affect each other, but at the end of the day, they're two completely different ecosystems. And the reason why that is because the stock market is driven by wealth creators, businesses, corporations, and greed, and is essentially predicated on the idea that there will be enthusiasm in the market and then fear in the market, and then enthusiasm in the market and then fear in the market, right? So this sort of push and pull of money, which is I guess you could call it money weather, which is basically what it is. It's like the stock market's like it's like money weather. You know what I mean? But something totally different than the economy itself. Jobs and unemployment rates and consumer spending, which again can affect certain stocks. But basically, the way that it used to be in America was that a company would form, and they would come up with a product that they wanted to sell. They would have an engineer of some kind be the CEO of that company, mainly to basically use his knowledge of product making on how to make a very good product that will sell, because that was key to making money. And then, of course, they would hire marketing experts from the top schools, and those marketing experts would come in and figure out how to build a brand, how to create an identity around your product, or how to emerge your product into the lifestyle culture, create a lifestyle brand from your product, and all this type of stuff. That's not really what it is anymore. Businesses now go about things totally different, because just like you can invest in stocks, so can businesses, so can corporations. And since the 80s, they have been humongously in very large amounts. Businesses are like, you take a General Electric, or you take an AT&T, or you take any of these huge corporations. They're taking tens of millions of dollars, sometimes hundreds of millions of dollars, and they're using it to buy stocks, lots of them, and buy out companies. And then, and even their companies and all their shares are being bought by other companies, and so on and so forth. That's the reason why companies like BlackRock, for instance, own so many things. It's because they've bought up stock in all these different corporations, and then those corporations bought up stock in all these other corporations, and so on and so forth. And so through this whole entire thing, BlackRock becomes, it's a trickle-down effect where they sort of own all these corporations that are underneath them by way of owning shares. Anyway, I don't want to get too into the weeds on this, because I want to focus on what this video is particularly about, which is why you're not rich. And this is what I want to break down for you. So this right here that I have on my screen is the entire totality of what stock markets have returned year by year when you've invested in ETFs. Now, for those of you who don't know what an ETF is, it's essentially a bundle of stocks. Rather than investing in a company, it's a portfolio of many companies, right? Now, this is just the average of the years. In 2006, there was a 15.7% return. 2007, 5.4%. 2008, major crash. We had a loss, 36.7%. As it continues all the way up to now, which, by the way, 2025 is not accurate at the moment. It's actually higher than 8.1% right now. But what this shows you, and yes, there's 3 reds where we've crashed 3 times, but repeatedly and repeatedly and repeatedly for the past 20 years, it has gone up and up and up and up and up and up. If you were to pull up any chart of any stock, you'll see a wave and then a wave and then a dip and then a wave and then it'll go up and then dip and then up and then dip and then up. But if you zoom out far enough, you'll see that it's just constantly been going up, 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 up. And that is because America has economic growth in general. In general. I mean, that's just the way it is. So to invest money into ETFs is essentially investing money in America, the American economy, into America and in its success period. Now, the reason why I'm bringing this up for you specifically who's watching this is because I want you to think about it, right? Let's say you have a basic job. Let's say you're somebody out there right now that's very struggling hard. Like you're barely getting by. You're working 2 jobs even. You're working at like a Dunkin' Donuts or something, or, you're bagging groceries at, a grocery store. And you're like, yeah, all that stock stuff is for wealthy people. It's not for me. You're wrong. And I'm going to tell you why. I want you to think about throughout the course of a year, how many times you spent money on things you really didn't need. Let's say or lent money. How many times have friends said, hey, can you loan me $50? Can you loan me $20? Can you loan me $40? And never paid you back, right? People that you had faith in and you were like, yeah, I'll give it to you. They'll give it back. And then you were waiting for her to get it back or whatever. Or spending money on going out and saying, I'm just going to go out and have drinks this weekend or whatever. And think about how many times these frivolous expenditures add up, right? Even to be $200 a month, right? Even if you could find even $100 a month, okay? Of just random moments where you bought some crap you didn't really need, or you bought some stuff for the house, or everybody can find these expenditures. Everybody can. I don't care who you are. We all do it. We've all been guilty of it. These little things, these little moments, they add up over the course of the year. I myself, just lending people money who never paid me back. When I did my taxes and looked at my expenses, I lent out probably somewhere in the neighborhood of like over $25,000. That's just, random people asking for 200 here, 500 there, 300 there, 100 here, 200 there, 500. Like it adds up. Now, for those of you who don't have enough money to loan out 25 grand, I'm sure that just lending people money and buying frivolous things or spending money on frivolous expenses, you could figure out where you maybe wasted, even a 100 and let's say $150 a month. Let's just say $150 a month. So now, and the reason why I'm telling you this is because if we were to calculate $150, well, let's just say that you $150 on average for the whole year would be like $1,800 a month that you maybe could have saved, right? But you didn't save because you looked in your bank account, you saw you had a little bit of money, and you said, I can go out drinking this weekend, spend it on booze, getting some liquor, shots, whatever, buying my friends shots, whatever, that kind of crap. Living your life, right? Living your life is what they say, right? Being happy, doing things that make you happy, this, that, and the third. Let's say you could find $150 a month that you could have spent differently. That's $1,800, okay? Now, let's say at some point, okay, in your life, maybe you got a tax return in February. Let's say at some point you got a tax return, you came up and you started with $500 and you said, I'm going to buy $500 and I'm not even going to buy stock. I'm not going to buy Apple or, Google or any of these companies. I'm just going to throw it in the S&P 500, which is an ETF, right? Or maybe divide it across a few different ETFs. Let's say you threw like $100 into 5 different ones. Okay. So here's what I want you to understand. You did this $500, and then over the course of the year, you're frivolously spending like $1,800 easily a year. Most people, I guarantee you, it's more than that. But I'm trying to be generous here. Now, here's what I want you to look at. So we're going to go ahead and we are going to move this over here. And we're going to grab this calculator right here. Now, let's say that you took $500 in the very beginning and you put it in there. And then every month, instead of spending that $150 on frivolous stuff, you threw it into like the S&P 500 and like we said, divided it across 5 different ETFs. If you were to do that, that would be $500 plus $1,800 over the course of that year, which would be $2,300. Now, let's say you had done this in 2006. We're going to go on data in the past. That's all we can go on. But we know that this data has proven to be back tested for decades. And we know that, the stock market continues to get, bigger and bigger and wealthier. And that's just what we know. So $2,300 at the end of the first year. If you had done this in 2006, and I'm speaking to most people who are older, because obviously a lot of you who are younger who might be watching, you should be paying attention for thinking of this in future reference because you're young and you can avoid a lot of mistakes that some of us older people have made. But let's just say you add that $2,300 in there. You're just doing the $150 in there every month on top of the initial $500. At the end, 15.7%. So we go plus 15.7%, which would be $2,661.10. Now that's at the end of 2006. Now you do it again. Okay. We go another 1,800 because you're still putting that 150 in there. And now we go plus 5.4%. Okay. Now we're at $4,701. Now you do it again. You put in another $1,800 in there. And now there's a crash, market crash. It went down 36.7%. Because in 2008, we have crashes. They happen very often, once in a blue moon. They happen, every few, 5 or 10 years, whatever they happen. So we subtract 36.7%, and it comes to $4,115. Now you do another 1,800 in there, okay? And now the market goes up 28.9%. The ETFs, rather, are paying, right? So now we add plus 28 point, I said 7. It's supposed to be 9. It'll still be pretty accurate, but 28.7 as opposed to 28.9. So it'll be slightly under what it would be, but it's okay. Now, that's 2009. Now we get to 2010. You put in another 1,800, and it goes up another 17.4%. So already in 4 years, or at the end of 5 years, you're at $9,092. $9,092 just sitting in the markets doing its thing around 2010. Now you put another $1,800 in. And the market jumps 1%. Or your ETF returns go up 1%, I should say. 2012, put another 1,800 in. And then 16.5%. 2013, you put another $1,800 in. And your ETF returns go up to 33.5%. Now, by 2014, You add another 1,800. And then 12.5%. And then 2015, you add another 1,800. And it goes up 0.4%. And now, 10 years later, you're now at $29,041. Almost, basically 30 grand. You're at $30,000. So, this is how this works. Now, obviously, maybe you go out and you drink with friends a little less. Maybe you lend people money a little less. Maybe you have to sacrifice not getting that stupid little ornament that you were going to buy when you were hanging out with friends that you thought would look good in your bedroom. I'm talking about minor stuff here. Minor stuff. Now, you're at 30 grand in 2015. We're going to keep going. 2016 comes, you put another $1,800 in there. Again, this is only $150 a month. That's it. Your ETF returns go up 12.8%. 2017, you put another $1,800 in there. Your ETF returns go up 21.2%. 2018, you have a small little crash. So you put your 1,800 in there and you subtract 5.2%. Little bit of a dip. You barely felt it. 2019 comes around. Another 1,800. Market skyrockets. Your ETF returns go up 30.7%. 2020 comes. You put in another 1,800. Now, this was the year of COVID. Keep in mind. The year of COVID. Imagine that. You put that in, 1,800, and your market ETFs go up. Your ETF returns go up 21%. Now, in 2020, you're sitting on $74,208. We're going to keep going. 2021 comes. You put in your $150 a month. And your ETF returns go up 25.7%. And then 2022 comes, and you have another crash. Third crash in 20 years. So what happens? You put in your 1,800. Okay. You subtract 19.5%. You felt that a little bit. Went down about 12 grand. But 2023, you bounce back. You put in your $150 a month. Your ETF returns go up 26.1%. And you're back in the money. 2024 comes. You go ahead and you put in another $1,800 a year. Your $150 a month, and your ETF returns go up 23.8%. That's $127,369. Now, 2025 comes this year. You put in your 1,800. And instead of 8.1%, according to what my most recent statistics tell me, it's around 12%. So we're going to do 12 instead of 8.1 because this was, at the time this image was made, it was older. So we're going to go up 12%. The money in the course of that 2006, you're working at Dunkin' Donuts, McDonald's, you're working at Bagging Groceries. You put $150 a month into the stocks. And your ETF returns year by year since 2006, you're sitting on $144,000. $669. Now, keep in mind that there's a number of times when you've gotten tax returns, maybe when something happened or you made a little bit of money on something, you sold a couple of things, whatever the case may be, that you could have thrown another 300, another 500 here and there. And this could be up to $250,000 that you would have just sitting in the stock market. Okay? Now, let's just say that you decided that each time that you had done this, when you got your tax returns, you wanted to put in 1,000 or a couple of thousand. And let's say that you got this up to like 500,000. Okay? You can get a line of credit where you could borrow, okay, up to about, I believe, 80% of your portfolio. So let me explain. So if your entire stock portfolio is worth $500,000, we're going to clear this. $500,000, we'll say minus 20%. You could borrow, it should have been easy enough. You could borrow up to 490. That was wait a minute. No, what am I doing? That's 400,000. Anyway, $400,000 against that $500,000 portfolio. You could borrow 400 grand. So now let's say you did. Let's say you took a line of credit out and you borrowed $400,000. What are you going to do with that $400,000? Well, let's say you could get let's go to ChatGPT here and let's ask it how much would a 4-unit apartment building in, let's say, I don't know, let's pick a pretty happening city. Let's say Nashville. How much would a 4-unit apartment building in Nashville, that's a pretty popular area, in Nashville, Tennessee, cost if each unit was a 2-bedroom? And the apartment building was in a decent area. Let's see. What would a 4-unit apartment building, each unit being a 2-bedroom apartment? Let's see. On the lower end, smaller or value-add properties between $1 and $1.5 million. Mid-range, $1.5 million to $2.5 million. Okay. Well, you need to put 20% down, right? So if you're going to put 20% down and you have $400,000, well, that would mean that you could buy a $2 million apartment building in Nashville. So now let's say you did. Okay, let's do this. In a $2 million apartment building, what a $2 million apartment building with 4 2-bedroom units in Nashville, what would each 2-bedroom unit rent for monthly? Let's find out. So, $2,200 to $2,800. So let's find the mid. Okay, that's a $600 difference. Let's go 3 up. So $2,500 a month. That means that this apartment building would make you $10,000 a month in rent coming in. Now, if you bought it with a line of credit, okay, which again, keep in mind that a line of credit does not lock in an interest rate. It would actually be good to convert that line of credit later to a mortgage, but I'm not going to get into the weeds, but that would be a good thing to do to lock in that interest rate if it's a good interest rate. If it's not a good interest rate, probably a better idea to do a line of credit, because when the interest rate gets better, that line of credit or your monthly payment that you'd have to pay towards it. But let's just say that the bank says, we're going to give you $400,000 because we know you have $500,000 in your stock portfolio. So we're going to loan you up to 80% of that, right? So now let's say you get that $400,000 and you use it to buy a 4-unit apartment building in Nashville, Tennessee, where each unit is 2 bedrooms and you're bringing in $2,500 a month. Even if your monthly bill to pay off that loan of $400,000, which I'm not going to sit here and calculate the loan, but all it has to be realistically is less than like $9,500 a month, because you're bringing in 10 grand a month and all you need is a positive cash flow. That's it. Now, I guarantee you're not going to need to pay $9,500 a month. It'll probably be somewhere around $2,000 or $3,000 a month, to be honest. Maybe $3,000 or $4,000, but you'll be making $4,000 or $5,000 a month cash flow on that apartment building. And then with that cash flow, you would then not only be paying down your line of credit that you borrowed, but you could even be reinvesting that into your ETFs, hereby growing your wealth even further. Okay? Because ETFs yield. Some of them have a yield, 4%, 6%, 2%. That annual yield compounds. So as your money is growing in that stock, that money that you're getting back at the end of the year is also going in. And this is how you amass capital, which is the name of the game. This is how you amass untold amounts of wealth. By never touching your money, leaving your assets in stocks that are producing money are producing wealth as an asset that you can borrow against. Leverage is the correct term for that. You now can leverage those assets and use that money to purchase more assets that you then can leverage again. And this is the cycle of wealth. And this is how you could very quickly go from being someone who works at Dunkin' Donuts and McDonald's, or bagging groceries and working at AutoZone, to within a lifetime, or sure, not even like a decade, having enough money where you're a millionaire. But what we do as people a lot of times is we get into this small mind mentality where we just get up and we go to McDonald's and we do our job, or we go to Dunkin' Donuts and we struggle and we barely get by. And when we do have a little bit of money, we're like, oh, I just want to buy myself that nice jacket. I deserve it. I work so hard at McDonald's. I just want to go spend money buying my friends drinks and go have a good time with my buddies at the bar. Okay. Well, that's fine, and you can enjoy life, but that's also why you're not rich, and why you'll never be rich, and why you'll work and be a slave to money for the rest of your life. And you might say, well, what about living your life? I'm pretty sure that after 10 years, when you're sitting on millions of dollars, you'll have a lot of fun. Because now when you go out with your friends and you buy everybody drinks, you can afford to spend that and lose it and not care about it because you make that amount of money. It becomes a situation where you having fun costs less than what you're making every year. Instead of you slaving 40 hours a week, sometimes 50 or 60, working multiple jobs, trying to get your money and trying to get ahead. It's compounding your wealth, compounding your money. And it can start as simple as a few $100. A few $100. And I try to tell a lot of my friends this because I have so many friends that are living right now where I started, which is living with nothing and struggling hard to like get by and feed their kids. And I know it's hard, but it's really not. It's really not that hard to scrape together some money and figure it out. It takes sacrifice, sometimes a lot of sacrifice. But it's all about your choices. It's all about your decisions. And understanding that what you're betting on here, people say, well, I get afraid of putting my money in the stock market. I'm afraid of losing it. The only way, if you're doing that, now again, you could go gamble with stocks. You could go gamble on options trading. And I'm gonna bet that this stock's gonna go down by the end of the day. You could do day trading and all this stuff. That's really high risk, high reward situations where you could lose everything you have. What I'm talking about here is just investing in ETFs, which again are portfolios of several of the biggest businesses in America. There are tech ETFs. There are consumer consumer product ETFs, and where they bundle all these different types of companies into a portfolio that you're investing in. So to believe that your money won't be valuable in the future is to basically bet against one. You're basically saying that the greedy will no longer be greedy, and that they'll all come to their senses one day and decide that money is not everything, and that they all won't care about profits and making money. We all know that's never going to happen. And the other thing is that you're saying that America's going to collapse, and that our economy is going to collapse, and that all of our businesses are going to go under. And if that happens, we have far bigger problems than worrying about where our money's been spent. We will be in a very dire situation as a country. So considering that neither one of those things is ever going to be true, and that every day you wake up, math is going to still be math, and numbers are going to still multiply and add and subtract and divide the same way over and over and over again every day, you're really not risking much. You're really not risking much. The only thing you're risking is your own personal need to spend money frivolously on having a good time or having stupid little odds and ends that you really don't need. So, that being said, it all comes down to your choices, but don't be afraid of investing in ETFs. Don't be afraid to open up that Robinhood account, open up that Fidelity account, open up that account with one of these, one of these trade brokerage firms, and get started. It's so easy. They've made it easier now than ever. Pull out your phone, put some money in that app, and start small, and just let your money compound. Because if you don't, and you continue to put small little menial things ahead of doing that, then by the time you do get 50, 55, 60, 65, when your body starts breaking down and you need a heart surgery or something, you're not going to have the money. You're not going to have the money. You're not going to have any money to take care of your health, which is very expensive. Paying for health insurance, I mean, I pay like $550 a month for that. And I don't even have the best coverage. So I can only imagine with somebody that is scraping by every month, you got to find a way to accumulate capital at all costs. And if you don't, then that's why you're not going to get rich. Anyway, my name is Tom Kane. Please hit the like button, hit the subscribe button. This is another episode of the Executives Playbook, and I hope to see you all.